A company named Robiscube decided to replace the existing computer system of their organization. Original cost of the old system was 25,000 and it was installed 5 years ago. Current market value of old system is 5,000. Depreciation of the old system was charged with a life of 10 years. Depreciation of the new system will be charged with a life of 5 years. Estimated salvage value of the old system was nil. Present cost of the new system is 50,000. Estimated salvage value of the new system is 1,000. Estimated cost savings with new systems is 5,000 per year. Increase in sales with new system is assumed at 10% per year based on original total sales. Company follows straight line method of depreciation. Cost of capital of the company is 10%, whereas the tax rate is 30%. So you have to decide whether this company should go for replacement. So what we are going to follow here is incremental cash flow. We have to follow the incremental cash flow method to take a decision, that is whether this company should go for the replacement or they should continue with their existing computer system. Okay, so now what we'll do, we'll find out what is the incremental outflow. So we'll have a working note 1 where we'll find out what is the incremental outflow. Working note 1, incremental outflow. So what is the present cost of the new system? Let us capture that present cost of the new system, and that is 50,000. So when the company goes for this project, they will not continue with their existing one. So they'll be disposing of their existing project and there is going to be an inflow, right? B less net sale value of old system, less net sale value of old system. But that is going to have some small working notes. Let's capture them. See, at what value you can dispose of. The question says the current market value of the old system is 5,000. So we'll capture that. Market value is 5,000. But you have to know whether you are disposing it at profit or loss. Okay, and for that you should know what is the book value. So what we'll do, we'll calculate what is the book value of the system that is sold. So how do we do that? Let's go back to the question. Question says that the original cost of the system was 25,000 and it was installed 5 years ago. The estimated salvage value of the old system was nil. So this information will help us to understand what is the book value. So let me capture. What was the original cost? Original cost is 25,000 and estimated salvage value. Estimated salvage value was nothing. Okay, and the life was 10 years. Life is 10 years. So from this we can find out the depreciation. Depreciation would have been this original cost minus estimated salvage value divided by useful life. So every year depreciation would have been 2,500, and already this mission has completed 5 years ago. Okay, so we'll capture expired life. Expired life should be 5 years. So what is the depreciation, or we'll say accumulated depreciation? What is the accumulated depreciation on this mission? And it is nothing but 2,500 into 5, 12,500. So we know the accumulated depreciation. If we deduct this accumulated depreciation from original cost, we'll get the book value. So I'll write book value, and that's nothing but A minus F. Okay, so that's going to be 25,000 minus 12,500. So the book value is 12,500. Now once we find the book value, let us also find whether this asset was sold at a profit, whether this can be sold at a profit or loss, because that will decide whether you are going to have profit on sale or you are going to have tax savings or tax expenses on sale, because it can be sold at profit or loss, right? So we'll have working note 3, that is computation of tax on sale of old asset. Okay, so we know what is the book value now. What is the book value? It is 12,500, And what is the market value? Market value is very less. We know market value, let's capture, we have it here, it is 5,000. So is it at profit or loss? It's actually at loss. So what's going to be the loss? Loss will be 12,500 minus 5,000. And this loss will enable the company to save tax, assuming there are other profitable projects. So less, or say tax saved on loss. Tax saved on loss. So what is the tax rate? Let's go and check. Tax rate is 30%. So item E, tax saved on loss, or item D, tax saved on loss is nothing but C multiplied by 30%. Okay. So here let me capture it is 7,500 into 30%. The tax saved on loss is 2,250. So if the company is going for new project by selling the old system, they are going to get this market value, no doubt about it, but they are also going to save on tax. So that is also going to be an inflow because savings are considered as inflows. So item number 2, tax saved on loss, and how much is that? It is 2,250. So these two put together will let you know what is the total sale profits, which is 5,000 plus 2,250. Okay, so if you can subtract this 7,250 from 50,000, you will get to know what is the net cost of new system. So net cost of new system, and that's A minus B, is 50,000 minus 7,250. So your net cost of new system is only 42,750. So successfully we have calculated what is the incremental outflow. Now let us find out what are the incremental operational flows. So let me have them here. Working note 4, computation of incremental operational flows. Okay, so we should know what is the additional cash flow we are going to get because of this new project. So first of all, we should know what is the increase in sales that is going to happen. The question says increase in sales with the new system is assumed as 10% per year based on the original total sales of 1 lakh. So we can say increase in sales. Item A, increase in sales as 1 lakh multiplied by 10%. Okay, so that's going to be the increase in sales is 1 lakh into 10%, that is 10,000. Then there is also some cost savings that is going to happen. What is that? Estimated cost savings with new system is 5,000 per year. So here let me capture. It's going to be, let us capture what is the savings we have by taking up this mission. There is an increase in sales that we know, but there is an estimated cost savings with the new system that is going to be 5,000 per year. Okay, so I'll capture that here, savings in cost, and it's going to be 5,000 every year. So this is going to be the total inflows which is going to happen because of going with this project, but this is inflow only from this project, and already you have some inflow, but let us also capture what is the incremental benefit. And please be guided, this increase in sales actually talks only in incremental language. Okay, so the existing sales and new sales are compared, and that's how we got this increase in sales. Similarly, savings in cost, existing cost and new cost were compared, and hence savings was arrived. So we can take this and we'll proceed further. So there is an incremental cash flow of 15,000, and let us also uh, give effect for depreciation. We have to give effect for depreciation because there is an incremental depreciation. How do you calculate the incremental depreciation? Already we have calculated the depreciation, and what was the figure we have calculated? Depreciation was 2,500, and if that asset is going to be continued, then 2,500 for another 5 years have to be provided. So that's going to be the existing depreciation. It means we have to calculate what is the new depreciation. So what's going to be the new depreciation? What is the cost of the asset? We know the cost of the asset is going to be 50,000, and it will carry some salvage value of 1,000, and the life is going to be 5 years. Okay, so that's going to be 50,000 minus 1,000 and divided by 5 years, that is 49,000 divided by 5. Okay, that's going to be the depreciation on new one. Okay, and we are bothered about the incremental. So on new asset, this is the depreciation, and on old asset, we know depreciation, we have already calculated, it will be 2,500 per year for next 5 years. Okay, so I'll put this as calculation. It's going to be 50,000 minus 1,000 divided by 5, so it's going to be 9,800, and old asset is 2,500. So what's my incremental depreciation? It is 9,800 minus 2,500. My incremental depreciation is 7,300. Okay, so now let me calculate the profit before tax. Profit before tax, and that's nothing but this 15,000 minus 7,300. So I'll give a name for this. I'll call this as C, total incremental inflows. Okay, so that is 15,000. Then I have incremental depreciation, I'll call it as D, and profit before tax is going to be called as E. Okay, so profit before tax is going to be item number C minus D, and again please remember this is only the incremental profit before tax. So let me use the term incremental profit before tax, and that is item C minus item D, which is 7,700. So let us apply tax on this. What is the tax rate? Tax is at 30%. So 7,700 multiplied by 0.3, so that's my tax. So I'll have incremental profit after tax, and that's going to be E minus F, simple. So this is 7700 minus 2310, so 5,390. So I can find the cash flows, incremental cash flows. Now I can find the incremental cash flows after tax, and that is item number G plus depreciation, that is item D. Okay, this G plus D, so it is 5,390 plus depreciation of 7,300, so it is 12,690. This is my incremental cash flow. Then let me also calculate my incremental terminal flow. Working note 5, incremental terminal flow. So what's going to be the terminal value of new asset? Terminal value of new asset, that's going to be 1,000, and terminal value of old asset, question says it is 0. So your incremental terminal flow is this, which is 1,000. So now you have all piece of information. Let's go and compute NPV. So working note 6, computation of NPV. It's basically PV of inflows minus PV of outflows, right? So we have to find out PV of inflows, and that's going to be the annuity which we have calculated, that is the incremental cash flows after tax, but that is going to continue for next 5 years, so we'll call it as annuity, and that should be multiplied by present value annuity factor for how many years? For 5 years. Okay, at the discount factor of 10%. Then there is also a terminal flow, so we have to find out the present value of terminal flow or terminal value. Okay, so that's the PV of inflow. Then we have to compare it with the PV of outflows. So let me finish off the PV of inflows. PV of inflows is going to be equal to the annuity of 12,960. Okay, and that should be multiplied with present value annuity factor for 5 years at 10%. So we'll go to the table. We'll go to the table, present value annuity factor table at 5 years across 10%, and it's going to be 3.791. Okay, it's 3.791. So this is one element in my PV of inflow. Then I should also have the present value of terminal value, right? So what is my terminal value? It is 1000, and that should be multiplied by PVIF. Okay, so that should be multiplied, probably I'll write that here. Present value of terminal value, this is nothing but 1000. Let me have the bracket here. Yeah, this is 1000 multiplied by PVIF, okay, across fifth year for 10%. So let's go and find out the value. That is 1000 multiplied by PVIF. So we should go to PVIF table. This is future value annuity table. Yeah, present value interest factor table. We have to go across fifth year 10%, and it works out to 0.621. So we'll put it here, it is 0.621. Okay, so if we complete this calculation, let's see what we get. Let me just copy this. PV of inflows is going to be equal to, let me just copy this part. Okay, I'll copy this part and I'll place that equal to so much. So here let me use that sign, exact sign. Okay, plus 1000 into 0.621. So that tells me PV of inflows are 49,752. So this is the present value of inflow. Now this should be compared with the present value of outflow. So what is my incremental outflow? This is 42,750. So let me write that. Present value of outflows is equal to, let me capture that, it is 42,750. Okay, so I should find out the NPV now. That's nothing but the PV of inflows minus PV of outflows. 49,752 minus 42,750. So I get NPV as 7,002. So let me check whether it's right. I think there is a small miscarriage mistake. That is, here I have taken PV of inflows. I have taken PV of inflows is equal to 12,960, but the right number is 12,690. Okay, so I should change this. This should become 12,690. So here also in the calculation I should change, it is 12,690. So what happens? This becomes 48,729, and outflows are 4,000 or 42,750. So my NPV is 5,979. So this is my NPV. This is my incremental NPV. That is, by changing the existing project and by going for this new project, I'm going to get an incremental NPV of 5,978, as the NPV is positive. You can say as NPV is positive, old asset should be replaced.